Dividend stocks are kind of garbage. Why are they garbage? Well, you kind of risk all that capital for just 1 to 5% a year. What's worse is that there are a lot of companies out there that don't even make enough to warrant a dividend. How do I know this? There's a nifty little trick that you can use right now, but you have to act fast or else it's gone. And that is to hit that big red subscribe button, hit that like button, and leave a comment and share this video. On a serious note though, I'm just here to provide an alternative perspective, not to change your reality. How am I able to tell a company's dividend is unsustainable? Well, there's a metric called the payout ratio. In layman's terms, if you made $1,000 a month, but you're spending $1,200 a month, your payout ratio would be 120%. That 20% difference doesn't come from nowhere. It's likely borrowed. And to be straightforward, that person loaning you that 20% wants their capital back plus a little interest on top of it. Then next month rolls around and say you can't make enough to cover the full 200 plus the interest rate. So you pay a little bit or maybe you can't pay it at all. It gets rolled over to the next month and again, same story, rolled over and to the point where a year has gone by or more and you basically get crushed by the debt. Those of you who have student debt know what I mean. Now that you have the basic idea, you should start applying it to see what some of these companies actually have under the hood. Here are some examples of companies that have like a 5% dividend yield, but also have a high payout ratio, which means that they're borrowing money to pay out the dividends. So for example, Iron Mountain with 159%, Pembina Pipelines with about 126%, and then the Williams Company, 132%. There are dividend ETFs out there that buy up these high payout ratio ones as well as low payout ratio ones that kind of balance it out, and they pay you out a dividend every single month or quarterly, whatever their distribution schedule is. But you also have to take in consideration what is the price of the ETF compared to the stock, the expense fees for that ETF, and whatever the dividend yield is for that ETF compared to if you just went directly into those stocks yourselves or built your own custom ETF and throw out the ones that you wouldn't put your money towards. Essentially, you're creating your own dividend ETF. There's also risks to that as well. On the same topic of dividends and ETFs, there are also ones that utilize different types of strategies, such as QYLD. This particular ETF is more of a strategy that's really popular among the FIRE and dividend communities out there. There are two specific reasons why I personally don't like this stock, and the first one is if you didn't catch it, here's it again. And the second reason is they're no better than some of these stocks I showed you in the example, especially when it comes to the payout ratio. Don't believe me? Here, I'll show my work for you. So this is how you calculate the DPR according to the CFI. So it's DPS divided by net income or earnings per share. QYLD didn't make it easy for me to find the EPS, so what I did was I took the price earnings divided by the current share price, and that's further backed up by this formula here. You guys can do this on your own, but it should come out to be about 1.67. Then you find out whatever the total dividend for the year is, so about in this case is about $2.52. So $2.52 divided by 1.67 gives you about a 150% DPR. Now, whether you think that your dollar is better spent here or somewhere else, that's a discussion you should have with a qualified financial professional who understands your situation, your risks, your dreams, your goals. Not some guy on the internet or a group of people who decide to ignore potential issues down the road, but still beat that same drum. I'm just here to offer an alternative perspective and opinion so that you might ask more intelligent questions and get better outcomes for yourself. But with that said, just remember, just because you're a day trader doesn't mean you have to trade every single day.